Today we are going to discuss about the structure of banking in India. The apex authority of banking system in India is the Reserve Bank of India. This is the central bank and it is the apex banking authority which controls the whole banking system in the country. The banks in India are divided into two. They are scheduled and non-scheduled banks. Scheduled banks are further divided into commercial banks and cooperative banks. The structure of Indian banking can be explained as in the following chart. Here, the structure of Indian banking system is given. Reserve Bank of India is the apex authority and the whole banking system is divided into scheduled banks and non-scheduled banks. Scheduled banks are further divided into commercial banks and cooperative banks. Commercial banks are divided into public sector banks, regional rural banks and private sector bank. Private sector bank comprises of Indian private sector banks and foreign bank. Public sector bank comprises of State Bank of India and other nationalized bank. Cooperative bank is the other sector or the second component of scheduled commercial banks in India. Scheduled banks in India. Cooperative banks are divided into state cooperative bank, central cooperative bank and primary credit societies. This is the structure of Indian banking system. Let us see in detail the structure of Indian banking system. The apex authority is Reserve Bank of India. It was established on 1st April 19 provision of Reserve Bank of India Act 1934. It performs various functions like developmental and promotional functions and it supervises and controls the banking structure of India. The central banks are known by different names in different countries. For example, Federal Reserve Bank of USA, Bank of England of UK, Reserve Bank of India in India, etc. Central bank is also known as Bankers' Bank. They formulate the monetary and credit policies of the country, and the Reserve Bank of India is owned and controlled by the Government of India, and they have the monopoly power of issuing currency notes of the country. These are the features and functions of Reserve Bank of India. The Indian banking structure is divided into two. They are scheduled banks and non-scheduled banks. Scheduled banks are those banks which are included in the second schedule of RBI Act 1934, whereas non-scheduled banks are those which are not included in the second schedule of RBI Act 1934. The scheduled banks have a paid-up capital and reserve of aggregate value not less than 25 lakhs and they have to satisfy the RBI rules also. All commercial banks, regional rural banks, state cooperative banks are scheduled banks. Scheduled bank must be a corporation or cooperate with the society. It should not be a partnership or single-owned firm. They also must satisfy the credit capital adequacy ratio or capital to risk asset weighted ratio norms and prudential norms of RBI. Non-scheduled banks are those banks which are not included in the second schedule of RBI Act 1934. At present, there are only 3 such banks in the country. Scheduled banks are divided into 2 categories: scheduled commercial banks and scheduled state cooperative banks. Scheduled commercial banks are divided into Indian as well as the foreign bank. The major differences between scheduled commercial banks and cooperative bank is in terms of their holding pattern. Scheduled cooperative banks are cooperative credit institutions that are registered under the Cooperative Societies Act. These banks work in accordance with the cooperative principles of mutual assistance, whereas the scheduled commercial banks perform in accordance with the rules and regulations of Reserve Bank of India. Scheduled commercial banks are divided into public sector bank, private sector bank, foreign bank, and regional rural banks. And non-scheduled banks are divided into non-scheduled commercial banks and non-scheduled urban cooperative banks. That is, non-scheduled banks are divided into non-scheduled commercial banks and non-scheduled urban cooperative banks. 3 local area banks and 5 non-scheduled urban cooperative banks comes under the non-scheduled. That is, presently we have only 8 banks that comes under the non-scheduled banks. The important local area banks are Coastal Local Area Bank, Krishna Bhima Samriddhi Local Area Bank, Subhadra Local Area Bank. These are the 3 local area bank that comes under the non-scheduled bank. And the non-scheduled urban cooperative banks are Alkant Anand Cooperative Bank, Alavi Cooperative Bank Limited, Amarnath Cooperative Bank Limited, Amod Nagrik Sahakari Bank Limited, Amreli Nagrik Sahakari Bank Limited. These are the 5 non-scheduled urban cooperative bank. That is, we have totally 8 non-scheduled banks in India. 3 are local area banks and 5 are non-scheduled urban cooperative banks. A comparison between scheduled commercial banks, scheduled banks and non-scheduled banks are given here. Scheduled banks follows the RBI rules, whereas non-scheduled banks do not follow the rules by the RBI. Scheduled banks are eligible for inclusion in the second schedule of RBI Act, while non-scheduled banks are not included in the second schedule of the RBI Act. This is the second difference. First one, the scheduled banks have to follow the RBI rules, whereas non-scheduled banks are not following the RBI rules. Second one, scheduled banks are included in the second schedule, whereas non-scheduled are those banks which are not included in the second schedule of RBI Act. Third difference is that scheduled banks are allowed to borrow money from RBI, whereas non-scheduled banks are not allowed to borrow from RBI. Scheduled banks will be a member of clearing house of RBI, while non-scheduled banks cannot be a member of clearing house of RBI. Another important difference is that scheduled banks and non-scheduled banks both need to maintain cash reserve ratio, but scheduled banks have to deposit this amount with the RBI, while non-scheduled banks can deposit this amount with themselves. That is, scheduled banks keeps their cash reserve ratio with RBI, whereas non-scheduled banks keeps this amount with themselves. These are some of the important differences between the scheduled banks and non-scheduled banks. Scheduled banks are divided into commercial banks and cooperative banks. Commercial banks are defined as an institution who accept deposit, lend loans and advances to general customers and businessmen. These institutions run to make profit. They are mainly for the financial requirements of industries as well as the agriculture and rural development. And the commercial banks includes public sector bank, private sector bank, foreign bank and regional rural bank. These are the commercial banks of the scheduled banks in India. Or scheduled banks are divided into commercial banks and cooperative banks, and commercial banks includes public sector bank, private sector bank, foreign banks and regional rural banks. The public sector banks are the banks which the government has a majority stakes in more than 50%. That is, in the case of public sector banks, more than 50% of the shareholdings will be with the government. And the shares of the public sector banks are listed on the stock exchanges. Currently, there are 12 nationalized public sector banks in India, and the public sector bank accounts for 75% of total banking business in India. That is, majority of banking business in India are carried out by the public sector bank. Among the public sector banks, State Bank of India is the largest commercial bank in terms of volume of the assets of the bank. The public sector banks in India are given in the following table. As on April 2020, we have 12 public sector bank. They are Bank of Baroda, Bank of India, Bank of Maharashtra, Canara Bank, Central Bank of India, Indian Bank, Indian Overseas Bank, Punjab and Sindh Bank, Punjab National Bank, State Bank of India, UCO Bank and Union Bank of India. Here the government shareholding, number of branches, then year of establishment and headquarters of these public sector banks are given, and the highest number of the branches goes to the State Bank of India, and it was established in the year 1955. It is headquartered at Mumbai in Maharashtra. And the oldest public sector bank is the Punjab National Bank, which was established in the year 1894, and it has a total branch of 11,437 and 70.22% of the shareholdings are with the government, and it is situated in New Delhi. These are the 12 important public sector banks in India. Next important category is the private sector banks. Private sector banks are banks where greater part of the equity are held by the private shareholders and not by the government. After most of the banks has got nationalized, those non-nationalized banks carry on their operations are known as old generation private sector bank, and those banks which were established with liberalization after liberalization is termed as new generation private sector bank. Some of the examples are HDFC Bank, ICICI Bank, Axis Bank. These banks are new generation bank. That is the basic difference between the public sector bank and private sector bank is that in the case of the public sector bank, majority of the stake shareholdings will be in hands of the government, whereas in the case of the private sector banks, majority of the shareholding is in the hands of the private sector. As on April 2020, we have 22 private sector banks in India. Their year of establishment, headquarters and number of branches are given here, and the largest number of branches are with the ICICI Bank. They have a branch of 4,882, followed by Axis Bank and HDFC Bank. A comparison between private sector bank and public sector banks are given here. Public sector banks are banks whose maximum shareholding is with the government, whereas in the case of the private sector banks, maximum shareholding is with the individuals and institutions. This is one of the important difference between the public sector banks and private sector bank. And at present, we have 12 public sector bank and 22 private sector bank. Majority of the banking business in India are done by the public sector bank. More than 70% are done by the public sector bank, whereas only nearly 20% of the business are done by the private sector bank. And public sector banks were established long ago, whereas the public sector banks emerged a few decades ago only. Another difference is that transparency in terms of interest rate policies are visible in the case of the public sector, whereas in the case of the private sector banks, we cannot see such transparency, and the rate of interest on deposits offered by public sector banks are slightly higher than the private sector bank. These are some of the important differences between the public sector bank and private sector bank. That is, majority of these shareholdings will be with the government in the case of the public sector. Nowadays we have 12 public sector bank. Majority of the banking business in India are done by the public sector bank, and it was established long ago, and their There will be transparency in interest rate, and the rate of interest usually provided by the public sector banks on deposits etc. will be higher compared to the private sector bank. These are the major differences between the private sector bank and the public sector banks. Another category of commercial banks are foreign banks. And foreign banks are those banks which have their head office abroad or in foreign countries, has to obey the regulations of both its home and its host countries. Loan limits for these banks are based on the capitals of the parent bank, and thus allowing foreign banks to provide more loans than other subsidiary banks. Citibank, HSBC, Standard Chartered, etc. are some of the foreign banks. Nowadays, we have 44 foreign banks in India. The list of foreign banks are given in the following tables. We have altogether 44 foreign banks presently as on April 2020. Another category of scheduled banks are regional rural bank. The Government of India set up regional rural banks, or popularly known as RRBs, on 2nd October 1975. And the major objectives of regional rural banks are provide credit facilities to the weakest sections of the rural area, particularly small and marginal farmers, agricultural laborers, and small entrepreneurs. We have nearly 43 RRBs in the country as on April 2020. The RRBs gets financial aids from the NABARD. The list of regional rural banks are given in the following tables. Their name, year of establishment, headquarters, number of branches, as well as the name of sponsor banks are given. We have 43 regional rural bank in India. Next category of scheduled banks are cooperative banks. Cooperative banks were set up by passing the Cooperative Act of 1904. They are organized and managed on the principle of cooperation and mutual help. Their main objective is provide rural credit, and they are based on the principle of cooperation and mutual help. They occupy an important role in rural cooperative financing. The enactment of Cooperative Credit Societies Act 1904 give an impetus to the cooperative movement in India. The Cooperative Credit Societies Act 1904 was amended in the year 1912. It was to give or to enable the formation or organization of non-credit societies. The basic objective of amendment of 1912 was the formation of non-credit societies. The cooperative societies are divided into three tiers. There are state cooperative banks, they are at the apex level, central cooperative banks at the district level, and primary cooperative banks at the local level. This is the structure of cooperative banks in India. The structure of cooperative banks by their asset size is given in this chart. That is, we have urban cooperative bank and rural cooperative bank, and it is divided into urban cooperative banks into scheduled urban cooperative and non-scheduled. Then rural cooperative banks into the state cooperative bank, district cooperative bank, and primary agricultural bank. And rural cooperatives are also divided into the state cooperative, agriculture and rural development bank, SCARD, and primary cooperative, agriculture and rural development bank, PACRDBS. This is the structure of cooperative banks in India. In addition to the above mentioned scheduled, cooperative and non-scheduled banks, we have some other types of banks that is prevailing in India. They are payment banks, small finance bank, and local area banks. Payment banks have been registered as a public limited company under the Companies Act of 2013. A committee headed by Nachiket Moore recommended setting up of payment banks for the purpose of helping the lower income groups and small business groups. These banks have been licensed under Section 22 of Banking Regulation Act 1949. Currently, we have seven payment banks in our country. In addition to the Banking Regulation Act 1949, payment banks will also be governed by the provisions of Deposit Insurance and Credit Guarantee Corporation Act 1961, RBI Act of 1934, Payment and Settlement Act of 2007, and Foreign Exchange Management Act of 1999. These are the regulatory mechanism for controlling the payment banks in India. And the main objective of setting up of payment bank is to ensure the financial inclusion by providing payments or remittance services to migrant labor workforce, opening up of small saving accounts of small business holders and low income households, workers of unorganized sector. That is helping the small business groups and the lower income groups are the major objectives of the payment banks. The important payment banks that exist in India are given. There are Airtel Payment Bank. This is the first payment bank in India. Then we have India Post Payment Bank, Jio Payment Bank, Paytm Payment Bank, NSDL Payment Bank, and Fino Payment Banks. Another category of banks are small finance bank, and their major objective is the furthering of financial inclusion by undertaking basic banking activities to unserved and undeserved sections, including small business units, small and marginal farmers, micro and small industries, and unorganized sector. These types of banks are also developed, or they are functioning for the welfare or for financing the lower income and small business groups. The small finance banks that are existing in India are given in this table. We have 9 small finance banks in India presently. Another category of banks are the local area bank. Local area banks are small private banks, and they are usually low cost banks, and they provide efficient and competitive financial intermediaries and services in the limited area of operation. They function mainly in the limited area, that is mainly in the rural and semi-urban areas. They are registered as a public limited company under the Companies Act 1956. These local area banks comes under the non-scheduled banks of India. They are eligible to be included in the second schedule of RBI Act, subject to the eligibility criteria of RBI. Important local area banks that exist as on April 2020 are Coastal Local Area Bank, Krishna Bhima Samriddhi Local Area Bank, and Subhadra Local Area Bank. These 3 banks comes under the non-scheduled bank. This is the structure of Indian banking sector. That is, Indian banking sector is divided into scheduled and non-scheduled. Scheduled banks are divided into commercial banks. We explained what is commercial banks. It is divided into public sector bank, that is State Bank of India and other nationalized bank, and it includes the regional rural banks and as well as the private banks. Private banks include Indian and foreign banks. Then scheduled banks are divided into cooperative banks also. It includes state, central, and district cooperative primary credit societies. This is the structure of banking system or structure of banking in India.